Good day, fellow investors. The Fed recently had its meeting, issued its statement, Powell had a press conference, discussed the policies, and the focus of the investing environment was set on that. In this video, we're going to discuss the danger of the focus being on the Fed, of course, the key policies, the key things that impact the market and investing, because it will be a great introduction to what we will discuss tomorrow, which is Ray Dalio's view on what's going on. We can call the perspective on the Fed first order thinking, and then what Ray Dalio will show us tomorrow, second order thinking, what really matters. But we have to discuss what the Fed is doing in order to better understand tomorrow's real perspective on what's going on. So, as said, I am really amazed that now Powell is a superstar, and whenever the chairman of the Fed is a superstar, things are not good. Things are actually dangerous. Plus, whenever somebody talks about it, there is so much interest about what the Fed just said that is insane, and that by itself is a danger. And it shouldn't be like that. You should not know who the chairman of the Fed is. You should not care. That should be something that's not relevant, and then you know things are okay. When there is so much focus on what the Fed monetary policy is doing, that's a big danger for starters. And why there is so much focus on what the Fed is doing? Because the Fed is setting interest rates, keeping them low, and printing a lot of money to keep the liquidity sufficient to keep the economy going. Because then the conclusion is, without low interest rates and without injections of money, do I need to comment? Nevertheless, let's look at the key discussion points. So they said their target, as always, is to achieve maximum employment and inflation rate at 2% over the long run. With inflation persistently below 2%, they will let it rise higher for some time that it averages 2% over the long term. So they are saying, yes, okay, we will keep printing until inflation goes well past beyond 2%, plus we will keep buying treasury securities at least 80 billion per month and agency mortgage-backed securities by at least 40 billion per month. How does this look like? This is the effective federal funds rate over the last 5 years. They tried to push it to a normal level of around 2% in 2018-2019. That didn't last long. They had to cut it already prior to the COVID crisis, cut it back to zero in the COVID crisis. If we look at the last 10 years, you can see here that it was at zero for most of the time. But over history, it has never been so low, and we are now really at zero. And now the question is, what will come next? But more about the next tomorrow. Let's stick to the Fed now. The second key of the Fed is providing liquidity, and you can see the balance sheet, stable, 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 financial crisis, big jump, big provision of liquidity, more in the crisis of 2013. They tried to lower it for a while, but immediately repo issues, liquidity, overnight liquidity issues, and then the COVID crisis. And this is by how much they increased the balance sheet, which is really insane. This is 10x over 12 years. And their plan is to keep interest rates at zero for the next 3 years, even perhaps longer if necessary. And the market is reacting on this because the market is starting to see inflation coming, creeping around. And the market is rightfully concerned that if they let inflation go to 3, 4, 5% just for a time and only then intervene, if they will be able to intervene, because if they start raising interest rates, then the economy, the markets, everything crashes. Let me just show you that connection. So here is the interest rate in the blue and the Nasdaq index in the red. So you have here the first increasing interest rates in 2015-16, and the Nasdaq was at 5,100 points and it crashed to 4,500 points. Of course, other issues were there too, commodities, China, but you can see here the correlation. Interest rates up, markets down. Then everything was good, and then here with the last rise of interest rates, when the market said, okay, this is too high, don't increase interest rates above 2 points, because then the market started crashing and the Fed said then, okay, we are not going to increase interest rates, we are going to keep them stable, and they actually were forced to start lowering them, and then when they really started lowering them, the market took off. Now at zero, I don't have to tell you what the market did. This is the correlation, and over the very long term, you can see as interest rates were lower and lower, so did the market rise exponentially. Really interesting how it works. If we see history again with higher interest rates, I don't have to tell you what the market will do. Because higher inflation leads to higher required yields, higher borrowing costs for companies from governments, lower economic growth, and it's all a sum of forces that have a big impact on the markets, on equity values, on your investments, and that is why everyone is following it closely, because what the Fed says moves the markets. It doesn't really move the markets significantly, because since Wednesday we didn't have big moves. Okay, one big move, then a jump, and then again down, but the market is there where it was before the meeting. So these ups and downs are really irrelevant. They are good for headlines, but really irrelevant for long-term investing. However, this is again a little bit more important. As the market and the Fed is telling us inflation is okay and higher inflation is okay, then we can see that people are not happy with holding the 10-year treasury at 0.5 interest rate or real negative interest rates. If they say inflation is going to be 3-4%, then we want higher yields on our money that we give to the US government. And yields rise above 1.7%. They are not concerned, the Fed is not yet concerned, but at some point, if this keeps going on, they will have to be concerned. Of course, from a historical perspective, there is not much to be concerned because interest rates are still at extreme lows, borrowing costs for the government. However, you can see that it's not really something that you can control forever, depends also on the market. And we already had issues in the 1970s. Because there are some other things that impact the market. Everybody's so focused on the Fed, on the dollar, like that there is nothing else out there. On the left side, the red, we have the US 10-year yield from 0.56. It went up to now what we are, 1.5, 1.7, and you can see the stability of the Chinese rate that doesn't move much, 3.25%, which is twice what you get from the US dollar. So global investors, global forces might start to look differently at two economic powers of the same strength now, still a little bit ahead the US, but over time that might change, especially given the fundamentals, which starts to make it more difficult for the Fed to print money. As long as the US is the reserve currency of the world, that's easy. But more about that tomorrow. So click that like button and subscribe. I have already showed you lower rates push financial assets higher, and you can see the Nasdaq just going up exponentially over the last 30-40 years. S&P 500, if we just take a look, we are in the longest historical bull market ever of about 40 years, just up and up, because interest rates went down and down. So, as Buffett says, interest rates impact stocks like gravity, so we have to look at what will impact interest rates. The Fed says they will not increase interest rates and they will print as much money as needed. If that is so, just by stocks, put your money into stocks, real estate, take that, and you will be great. However, there is also the concerns that what can't last forever, as Charlie Munger says, at some point has to stop. And given how things are, given the very low interest rates, already small changes in rates can have big impacts on asset prices, on investments, and on investment scenarios. So I expect a lot of volatility over the next 10 years, so that's also something to keep into consideration. The higher the yield, the smaller the change, the lower the volatility. However, if we check my table of analyzed stocks, publicly analyzed stocks, you have all the links to the videos or to the research here, you can see that it's hard to find stocks that give 10% yield. Maybe we have discussed Verizon, so there is, let's say, fairly valued for a long-term 10% yield, but then there is also the dollar risk that we'll discuss tomorrow. However, if interest rates go up and down, this might be more defensive, and what we are seeing with the Nasdaq, then stocks that have no dividends, no yield, no earnings are just on promises. That is why you see these differences and this more sensitivity in highly exuberant stocks. You can download this all in the link in the description of the video. So that is one, a lot of volatility ahead. We'll watch what the Fed says, but tomorrow we'll discuss second level thinking, going deep into the actions that might really impact, importantly, investing over the medium-long term. The Fed, yes, short term, this up and down, but what really matters is the long term, and Ray Dalio has been very prescient in calling what the Fed is doing now with helicopter money, and he's now calling something else, and I'll see you tomorrow when we'll discuss that. Something more important than what the Fed farted yesterday.